Today we will discuss Unit 5 of International Finance, that is parity conditions in international finance and currency forecasting. First, let me tell what will be the structure of my discussion. First, we will discuss regarding what is parity condition. Next, we will discuss the relationship between price level changes and exchange rate. Next, we will discuss the relationship between interest rate changes and exchange rate. Next, we will discuss exchange rate and balance of payment. What is the relationship between them? We will discuss exchange rate and forex reserve. At last, we will discuss regarding REER and NEER. REER means real effective exchange rate and nominal effective exchange rate. In context of that, we will discuss regarding foreign currency baskets. We'll discuss calculation of REER, we'll discuss calculation of REER and how REER is computed in India. Friends, we have discussed regarding exchange rate. We know that exchange rate is the rate at which one country's currency is exchanged for other country's currency. That is known as exchange rate. There are many factors which affect exchange rate. Two of the most important factor which affect exchange rate is interest rate, another is price level changes. So price level changes means inflation. So there are two important factors which affect exchange rate. One is inflation rate, another is second one is interest rate. These are the two important factors which affect exchange rate. These are the factors affecting exchange rate. Now, what is parity condition? Parity conditions simply explain the theoretical international parity condition. So the link between these three. What is the link between exchange rate and interest rate? What is the link between exchange rate and inflation rate? What is the link between inflation rate and interest rate? These things are discussed under parity conditions. So international parity conditions link these three things. What are the three things? International parity condition link price level changes, interest rate and exchange rate. This theory is the core of international finance. So international parity condition establishes a link between inflation rate, interest rate and exchange rate. In this context, first we will discuss the relationship between inflation rate and exchange rate, that is price level changes and exchange rate. What is the relationship between price level changes and exchange rate? In this context, we will study two important laws. What are the two important laws? First we will discuss in this context. First law is law of one price, law of one price, and second one is, first one is law of one price, second one is PPP theory. So under price level changes and exchange rate, we will study two important laws. One is law of one price, law of one price. Another is PPP theory. What is PPP? Purchasing power parity theory. We will study two important law of one price theory, another is PPP theory. First, we will understand regarding law of one price. What is law of one price and how this particular concept affect the exchange rate? Law of one price tells that if two similar goods are traded in two different countries and their prices must be similar. What does it mean? It means, let's take an example. There are two important countries. One is India. Another is USA. Two countries are there. India is a country, USA is a country. Suppose one packet of bread, the cost of bread in India, let's take an example, is 200 rupees. And the similarly, the cost of that one packet bread in USA is, let's take an example, $2.5. So law of one price tells that if two similar product, a similar product is sold in two different countries, their prices must be similar. It means the exchange rate 200 rupees will be equal to $2.5. So what is the price of $1? $1 exchange rate will be 200 by 2.5, that is equal to 80 rupees. So $1 will be 80 rupees. This is law of one price. If $1 is not 80 rupees, arbitrager will enter into picture. They will buy in low priced market and sell in high priced market and make some arbitrage profit if there is no restriction on import and exports. Okay, so law of one price tells that if an identical goods or service is sold in two different countries, the prices of the goods or service should be same in both the countries. If there is no restriction on sale and transportation of goods, in case there is free movement of goods and services between two different countries and similar product is sold in two different countries, their price must be same. If the price is not same, people will buy in low priced market and sell it high priced market. They will purchase that particular similar commodity in the country where the price is low and transport it and sell it in the country where the price is high and make some riskless profit. And ultimately, the country where price is low and people are buying there, in that country the price will start increasing, and ultimately where the price is high, people are selling the product and price will come down, and ultimately there will be an equilibrium in that conditions where the price of two similar product in two similar country are similar or same. This is known as law of one price. This is called law of one price. So law of one price holds goods if there is no friction in the market. What does friction means? Friction means restriction. If there is no restrictions in the market, then what will happen? Law of one price will hold good. So this is the first important law which establishes the relationship between price and exchange rate. Next, we will discuss regarding another important law of exchange rate, that is PPP theory or purchasing power parity theory. PPP theory is also used to compare exchange rate through a basket of goods. It also advocates law of one price, but not for a single goods, but for a basket of goods. What does it tells? Let's take an example. One country is there, India. Another country is there, USA. In India, there is many goods which are put in a basket. And in baskets, there are A, B, C, D, E, 5 goods. And the cost of this basket in India and cost of similar basket in US must be same. A, B, C, D, E. Similar goods are purchased in India and similar goods are purchased in US. And this purchasing power parity theory tells that the price of this basket of goods in India and US must be same. So there are two versions of purchasing power parity or PPP theory. What are the two versions of PPP theory? One version is known as absolute purchasing power parity theory, which is denoted as APPP. What is APPP? Absolute purchasing power parity theory. Absolute PPP. Another is version is relative purchasing power theory, RPP, relative PPP. So we will discuss what is absolute PPP and what is relative PPP. Absolute PPP theory explain the relationship between price and exchange rate over single point of time, single point of time, single point of time. Whereas relative version explain the relationship over two point of time, two point of time. So 2 point means 21 22, that means on change basis it explain the relationship, on percentage change. So there are two theories, APPP theory and RPPP theory. APPP theory tells regarding absolute PPP and relative PPP theory tells regarding the relationship over 2 point of time or over a period of time. So first we will discuss regarding absolute purchasing parity, power parity theory. APPP theory or absolute purchasing power parity theory is an application of PPP over single point of time. I have already told APPP theory explain the purchasing power parity over one period of time to determine the exchange rate between two countries. What absolute purchasing power parity theory tells? We know that PPP is based upon basket concept. Let's take an example. For instance, there is a basket of goods that cost $100 in US. In USA, a basket cost $100. And the same basket is purchased at 50 pounds in Britain. In Britain, the cost is 50 pounds. Now, what does law of one price tells? The price of similar goods must be similar, and PPP theory tells that the price of similar basket must be similar. The basket of goods is costing $100 in US and in Britain it is 50 pound. So I can tell that 50 pound is equal to $100. So exchange rate will be 1 pound will be equal to 100 by 50, that is equal to $2. So what is the formula used here? So in this case, the formula used for calculating exchange rate is E is equal to P1 by P2. This is important. E is equal to P1 by P2. What is E? E means exchange rate. E is equal to P1 by P2. E is equal to exchange rate. What is exchange rate? How exchange rate will be calculated? P1, price of goods in first country. In this case, first country is USA. So price of goods in first country divided by what is P2, price of goods in second country. P1 is equal to 100 and P2 is equal to 50. Now exchange rate can be calculated. 100 by 50 I have already calculated, that is equal to $2. 2 by 1 or exchange rate can be easily calculated. 1 pound is equal to $2. This is absolute version of purchasing power parity theory. But there are certain limitations of absolute version of PPP theory. What are the limitations? Limitations of PPP. What PPP? Absolute PPP theory. Two important limitations we will discuss. First limitation is, we know that price of similar goods or similar basket of goods must be similar into different country. That is absolute purchasing power control theory. So first limitation is, what is the content of the basket? Even if one price is correct in case of single product, what is the content of the basket? The content of the basket may not be similar. First point is the content of the basket may not be similar. There may be different goods in the different baskets. The content of the basket may not be similar. This is the first limitation. And the second limitation is even if the content is similar, the weight of the goods, weight means importance of the goods in the basket may not be similar. So we cannot get similar basket of goods consumed by the citizens in two different countries in the similar way. It is very difficult to found. So this is the most important limitations of APPP theory or absolute purchasing power parity theory. Next theory we will discuss relative purchase power parity theory or RPPP theory. We know that absolute purchasing power parity theory tells the relationship between price and exchange rate over single point of time. But relative purchasing power parity theory explain the same concept over 2 point of time. So relative PPP is the application of the same concept of PPP over 2 points of time. What is 2 points of time? There will be 2 time frames. Okay, so it tells that within 2 time frames, the change in the exchange rate will be equal to change in the price level. What does it tells? Relative purchasing power parity theory tells change in exchange rate, percentage change in exchange rate must be equal to percentage change in price level or inflation. The price level change percentage must be equal to the change of exchange rate, percentage change in exchange rate. We will explain, we will discuss this with the help of one example. For instance, on January 1, 2021, there is a basket of goods that cost $100 in US. 2 countries are there. One is USA, another is Britain. 2 countries are there. One is USA, another is Britain. 2 countries. Okay, and there is USA and Britain. And what cost? The basket of goods is there. Its cost is $100 in US. Its cost is $100 in US. In which year? In 2021. 2021, the cost is $100. And in similarly in UK or Britain, its cost is £100. £100. So what will be the exchange rate? $100 is equal to £100 means exchange rate will be $1 which is equal to £1. Exchange rate will simply be $1 is equal to £1. Okay, next, what happens? Next, the exchange rate should be $1 is equal to £1. After a year means in 2022, what happens? The cost of the basket in US has become $105. So $100 becomes $105. It means what is the percentage change? Kitna percent change hua? 5% change. There is 5% change in goods. Inflation rate is 5%. In Britain, the basket becomes £115. £115. That is 15% change. So Britain face a higher level of inflation than which USA. Then what will happen to the exchange rate? We will see. The relative purchasing power parity theory tells that if a country is facing higher inflation rate, its currency value will depreciate, and the country which faces lower inflation rate, its currency value will appreciate. And in order to discuss this, in order to find out the revised currency rate, there is a formula used in case of a relative purchasing power parity, and the formula is CE is equal to U1 by U divided by B1 by B. We will discuss what is CE. CE means change in exchange rate. What is U1? U1 is equal to price of goods after a year in the first country. What is the price of goods after a year in the first country? First country means where inflation is higher. Where this is first country, inflation higher. This is second country where inflation is lower. Okay, so first country means where inflation is higher, that is taken as first country. And price of goods after 1 year in the first country. In the first country, price of goods after 1 year is 115. So we take 115 divide by U. What is U? U is equal to price of goods in the beginning of the year in the first country. First country means where inflation rate is higher. So that is by 100. So 115 by 100. This is the figure. Whole divide by price of B1. B1. What is B? Where inflation rate is lower. Price of goods after a year in the second country. Second country, price of goods after a year is 105. That is 105. Divide by price of goods in the beginning of the year in the second country. What is the beginning of the year second country? This is 100. So if you will solve it, you will get 1.15 divided by 1.005, that is equal to 1.09. So what will happen? $1 was previously $1 was how much? In 2021 $1 was how much? 1 pound. But now what happens? In 2022 $1 is equal to 1 pound was equal to $1. 1 pound was equal to $1. Now 1 pound becomes $1.09. Okay. This is the case. Okay, now we will discuss. So what are the limitations? $1 was 1 pound. Okay, what are the limitations of PPP theory? We will discuss now the limitations of PPP theory. Now limitations of PPP theory. First, limitations. PPP work well in case of long period. Where there is a long period, in that case PPP work well. Second is PPP illustrates better result for countries with high rate of inflation. It works well where in case of long period. In case of short period, PPP theory does not work well. Second, it shows a better result in case of countries which are facing high rate of inflation. Second, third, PPP demonstrate better result for countries with underdeveloped capital market. The market where capital market is underdeveloped, PPP theory shows better result. Next, PPP does not work well where there is frictions. Frictions means restrictions on movement of goods and services. PPP does not work well where there is barriers to trade. What is barriers? That is tariff barriers and non-tariff barriers to trade. It put a restriction on free movement of goods and services. Where there is no restriction on movement of goods and services, there is free flow of goods and services between countries, PPP work well. PPP does not work well in case of non-traded goods. Okay, it works well only for traded goods. It does not work well in case of non-traded goods. So next we will discuss regarding PPP and exchange rate. We know that there are two type of exchange rate. One is known as nominal exchange rate, another is known as real exchange rate. So exchange rate is of two types: nominal exchange rate, another is a real exchange rate. Nominal exchange rate and real exchange rate. What is nominal exchange rate and what is real exchange rate? Nominal and real. Nominal exchange rate is the exchange rate given without adjusting inflation. Without adjusting inflation, that is nominal exchange rate. Real exchange rate is the inflation adjusted exchange rate, nominal exchange rate. If we make adjustment of inflation with nominal exchange rate, we will get real exchange rate. Okay. Now, real exchange rate between countries normally does not change with the change of price level, but the nominal exchange rate changes. Therefore, this theory, purchasing power parity theory, relative version, tells that the percentage change of exchange rate should be equal to the percentage change of inflation rate. So what does it tells? Exchange rate differential. Exchange rate differential. What is exchange rate differential? That is the percentage change of exchange rate. Percentage change of exchange rate should be equal to inflation rate differential. What is inflation rate differential? Inflation rate differential means percentage change in inflation rate. This is the crux of PPP theory. What is the crux of PPP theory? Crux of PPP theory tells that exchange rate differential. Which exchange rate differential? Nominal exchange rate differential should be equal to inflation rate differential, or percentage change in nominal exchange rate should be equal to percentage change in inflation rate. This is the crux or summary of PPP theory. Next theory we will discuss regarding Fisher effect. What is Fisher effect and what is international Fisher effect? Fisher effect tells regarding interest rate. What is the interest rate? Interest rate prevailing in different countries are different. We know that in India the interest rate is, let's take an example, 6 to 8%. But in USA it is 2 to 3%. In Japan it is 1%. So why the difference occurs in interest rate? Fisher tells that interest rate has two important components. One is nominal interest rate, another is real interest rate. What is nominal interest rate and what is real interest rate? Real interest rate is the inflation adjusted interest rate. Inflation adjusted interest rate, that is known as real interest rate. According to Fisher, the nominal interest rate and real interest rate, there are two important concepts. The real interest rate between different countries must be same. If real interest rate between different countries are not same, what will do? People will go for arbitrage activity. People will take a loan from the country where interest rate is low and invest in the country where interest rate is high and make some riskless profit. That is known as arbitrage process. So real interest rate between all the countries of the world must be same. But we see that interest rate are different between different countries? Because the interest rate we see, that is nominal interest rate. Nominal interest rate will be different in different countries basing on the inflation prevalent in their country. So in that country where inflation rate is high, nominal interest rate will be high. In that country where nominal interest rate is low, inflation must be low. So interest rate has two components. One is nominal interest rate, another is real interest rate. So real interest rate is the difference between nominal interest rate and inflation rate. Okay, the real interest rate throughout the world must be same, and nominal interest rate throughout the world are different. Why nominal interest rate throughout the world are different? Because of inflation rates throughout different countries are different. So Fisher effect tells that the concept of crux of Fisher effect is interest rate differential. Interest rate differential. What is interest rate differential? Percentage change in interest rate is equal to interest rate differential arises due to inflation rate differential. This is the crux of Fisher effect. The summary of Fisher effect is this: interest rate differential is equal to inflation rate differential. Percentage change in inflation rate between two countries should be equal to percentage change of interest rate between two countries. This is known as Fisher effect. Next, we will discuss a concept called international Fisher effect. What is international Fisher effect? International Fisher effect combines both the theories. What are both the theories? First, we have discussed regarding Fisher effect. Next, we have discussed regarding which effect? PPP theory. So, international Fisher effect combines the concept of PPP theory and Fisher effect. What does international Fisher effect tells? First, what does PPP theory tells? PPP theory tells that exchange rate differential, difference in exchange rate arises due to exchange rate differential arises due to inflation, change in inflation rate differential. This is PPP theory. Second, Fisher effect tells that, what does Fisher effect tells? Interest rate differential. Interest rate differential, difference in interest rate arises due to inflation rate differential. And what does international Fisher effect tells? International Fisher effect, we know that in these two sides, inflation rate is there. If we combine this, it will be cancelled. Then what rises? Exchange rate differential. Exchange rate differential is equal to interest rate differential. This is the crux of international Fisher effect. It is the combination of PPP theory and Fisher effect. Okay, this is international Fisher effect. So we have studied regarding three important theories. First, we have discussed regarding PPP theory. First, we have discussed law of one price. Then we discuss PPP theory. There are two versions of PPP theory: absolute, relative. Next, we go for Fisher effect. Next, we studied international Fisher effect. Next, we will go for interest rate parity theory or IRP theory. What is interest rate parity theory or IRP theory? IRP theory tells regarding forward rate differential. What is forward rate differential? We have discussed exchange rate is of two types. One is spot rate, another is forward rate. What is spot rate? The rate prevailing now. If you take immediate delivery, the rate is known as spot rate. But if you will take delivery of the exchange, foreign exchange, after 1 month, 2 month, 3 month, the rate that is available, that is known as forward rate. The difference between spot rate and forward rate is known as swap points, and that is known as, the difference is known as forward rate differential. We know that forward rate differential, how to calculate? Forward rate differential means the difference between forward rate and spot rate, percentage change in forward rate and spot rate. So that is forward rate differential. The forward rate differential and interest rate differential must be same. That is the crux of interest rate parity theory. What does interest rate parity theory tells? Interest rate parity theory tells that forward rate differential, that is the difference between forward rate and spot rate depends upon the difference between interest rate, that is interest rate differential. Okay, this is the concept of interest rate parity theory. This is the crux of interest rate parity theory. Interest rate parity theory link interest rate and exchange rate. Okay, this is the concept of IRP theory. So we have discussed regarding three different important theories of exchange rate. There are two versions of IRP theory. What are the two versions of IRP theory? First version is known as covered interest rate parity theory. Second version is known as uncovered interest rate parity theory. So there are two type of IRP theory: covered IRP, and second one is uncovered IRP. Two type of IRP theory: covered interest rate parity, uncovered interest rate parity. What is covered interest rate parity and what is uncovered interest rate parity? We can understand with the help of an example. Before discussing this, there is a formula of IRP theory. We have to understand the formula of IRP theory. The formula of IRP theory is F0 is equal to S0 whole into 1 plus a to the power n divided by 1 plus b to the power n. What is F0? F0 is equal to forward rate. What is S0? Is equal to spot rate. What is IRA? A means interest rate in home country. What is B? B means interest rate in foreign country. What is N? N is type. Let's take an example. The spot rate of between US and Euro is 1.10 US dollar or euro. So this is spot rate. Spot rate means S0 is given. What is S0? S0 is equal to 1.10. The interest rate in US is 3%. That is A is given. This is A is 3%. The interest rate in Eurozone is 4%. That is B is given. B is equal to 4%. Next, what do you anticipate the forward exchange rate to be after 1 year? एक साल बाद what will be the exchange rate? How to calculate? We have to apply the formula. Formula is F0 is equal to S0. What is S0? S0 is 1.11 into 1 plus a to the power n. 1 plus a means 3%. 3% means 0.03 to the power n. N means 1. Whole divided by 1 plus b to the power n. 1 plus b is 4%. 4% means 0.04 to the power n means 1. And if you will calculate, the forward exchange rate will be equal to 1.09. This is the formula used under interest rate parity theory to find out the forward exchange rate of a particular currency. Then we have discussed the interest rate parity theory is of two types. One is uncovered IRP, another is covered IRP. What is uncovered IRP? Uncovered IRP discuss the changes in interest rate and exchange rate between two nations over a period of time should be equivalent. But covered IRP take the help of forward exchange rate to establish the positions given under uncovered IRP. What is forward exchange rate? So covered IRP is a theoretical situation that asserts the spot exchange rate, interest rate, and forward exchange rate between two nations all in equilibrium. So there are two things. Uncovered IRP, it tells regarding interest rate differential and exchange rate differential. Covered IRP tells regarding interest rate differential, exchange rate differential, and forward rate differential. All these three should be equal. That is the concept of covered interest rate parity. So covered interest rate parity tells interest rate differential should be equal to forward rate differential. Should be equal to exchange rate differential. All three things must be in parity. This is the concept of covered IRP. Okay, so we have discussed different theories of exchange rate or parity conditions available in exchange rate. Next, we will discuss a concept of exchange rate and forex reserve. We know that every country has to maintain certain amount of forex reserve. Okay, China is the country having highest amount of forex reserve in its kitty. Okay, it is having more than $3 trillion of forex reserve. India is having now $800 billion of forex reserve. Okay, Pakistan is having $10 billion of forex reserve. Now it is begging before IMF and other countries for forex reserves because they do not have sufficient forex reserve. So India has a forex reserve crisis in 1991, where we have very few amount of forex foreign currency or reserves to meet our import requirements. It was only sufficient for 7 days, 7 to 14 days. So in order to get foreign exchange, we have to pledge our gold with Bank of England by that time. Okay. Now we are discussing regarding forex reserve. Each country has to keep sufficient amount of foreign currency as a reserve. The most used foreign currency for the purpose of reserve is US dollar. It is the internationally accepted currency. Therefore, most of the country keep US dollar in its reserve. Apart from US dollar, countries also keep reserve of Great Britain pound, Euro, it's the currency of Eurozone, Chinese yuan or Chinese renminbi, and Japanese yen. These are 5 important reserve assets: US dollar, Great Britain pound, Euro, Chinese yuan, and Japanese yen. I have already told the country which has highest number of forex reserve in the world, that is China. China is the nation with highest number of forex reserve, holding more than $3 trillion worth of foreign currency. Apart from foreign currency, in the reserve, countries also keep gold. People also keep gold reserve. So in forex reserve kitty, there are 4 components. What are the 4 components? Forex reserve. People keep these 4 things. First, they keep foreign currency. Then they keep gold. Then they keep SDR, statutory drawing rights. It's the currency unit of account of IMF. Then reserve tranche positions. This is the amount deposited with IMF which can be easily withdrawn. These four things consist the forex kitty of a country or forex reserve of a country. Next, we will discuss one important concept. That concept is known as nominal effective exchange rate, that is near, and real effective exchange rate, that is real. What is near and real, we will discuss. Now, please see, Indian currency might appreciate in comparison to dollar. It might depreciate in comparison to euro. It might appreciate in comparison to Japanese yen. It might depreciate in comparison to Chinese renminbi. So, with some currency, our value might increase. With some currency, our exchange rate might decrease or depreciate or appreciate. On an average, whether Indian currency has been performing well or not, we can find out with the help of EER. EER means effective exchange rate. So EER is a technique. Effective exchange rate is a technique to know the effectiveness of your currency or competitiveness of your currency against a basket of currency. Suppose one currency is INR, your currency is INR. One currency is Indian currency INR, Indian rupees, and there is a basket of currency. What are the basket of currency? In basket of currency, we have a dollar, we have Chinese rupees or Chinese renminbi, then we have Japanese yen, we have Great Britain pound, okay, we have euro. Whether Indian rupee has performed well in comparison to this basket, or whether Indian rupee appreciates in comparison to the basket or depreciates in comparison to this basket of currency, is studied with the help of EER, effective exchange rate. If we study it on the basis of nominal exchange rate, whether our nominal exchange rate has performed well or not, that is known as nominal effective exchange rate or NER. So NER consider effective exchange rate by taking nominal exchange rate. If you will consider real exchange rate, competitiveness, and in that case we consider RER. So NER and RER depends upon the competitiveness of a currency with a basket of currency. So in the basket, which type of currency we have to include? We have to include those countries' currency with which we have highest trading relationship. India has highest trading relationship with US, with China, with Japan, with UK, with Eurozone. Therefore, I have considered these 5 important currencies. Okay, so nominal effective exchange rate or NER is an unadjusted weighted average rate at which one country's currency is exchanged for a basket of foreign currency. NER is the amount of local currency required to acquire foreign currency basket. NER is a measure of country's international competitiveness in the foreign currency market. So you have to study the competitiveness of a currency with the help of effective exchange rate. Okay. Next, which basket must country which country's currency? I have already discussed the currency basket of the country must consist those countries with which you have significant trade volumes. your significant trade partners currency must be included in that basket for computation of NIR or RIR. Next, we will discuss how to calculate NIR or RIR. NIR or RIR can be calculated with the help of following formula. What is the formula? Formula is equal to RIR is equal to CRN to the power n into CR to the power n into 100. What is RIR? Real effective exchange rate. What is first CR? Exchange rate of a particular currency. And what is N? N means weight of each particular currency. Let's take an example. For example, United States, if a pound and euro and Indian rupees is equal to 1.16, 1 and 0.012 US dollar respectively, the real effective exchange rate will be calculated as follows. How to find out the effectiveness of a country? The effectiveness of a country depends upon the trading volume. Suppose US has trading volume with Eurozone, UK and India. US trade with Eurozone, UK and India. US trade with Eurozone is 65%. So its weight is 0.65. With UK, it trades 20%. So its weight is 0.20. And with India, it's trade 15%. So its weight is 0.15. So the weights are the percentage of trade a country does. So in this case, we have to just apply the formula and find out the value of RIR. CER into the power n. Three countries are there, exchange rate is there, weight is there, and we have to multiply all those and multiply into 100. So first country's exchange rate is 1.16, its weight is 0.20. Second country's weight is 1 and its weight is 0.65 to the power. Next, third country's current weight is, exchange rate is 0.0121 and its weight is 0.15. We have to multiply this and multiply the whole with 100 and we will get the value of RIR. RIR is equal to 0.027. Similarly, in India, RBI use a particular formula to calculate RIR. The formula used by RBI to calculate RIR is, this is in India we use this. Calculation of RIR, in case of India, we use the formula which is given by RBI. RIR is equal to E divided by EI into P divided by PI whole to the power W. What is E? E is the exchange rate and what is W? W means weight. What is P1? P1 is the consumer price index of the country. Okay, let's take an example. So these are the countries with which India has trading partnership. What are the countries? US, China, UAE. This is the basket. The basket consists of, India's basket consists of these 4, 5, 6. These are the basket currencies. And what is the weight? 30.60 is the weight of US, China 29.60, and this is 18.70. Saudi Arab, this is Switzerland, this is this. And the exchange rate is given, inflation rate is given. And we have to calculate a RIR for India or for US, for China, we have to calculate. Okay, let's take an example. We have to calculate RIR for US or RIR for China. For US, we have to calculate RIR. So RIR for US can be calculated with the following steps. What is the formula? E divided by E1. What is E? Exchange rate in India. In India, nothing is given. The exchange rate is for 1 rupees. So exchange rate in India is 1. Divide by, for US we are calculating. The exchange rate is 815.09. This is the exchange rate, 815.09. Okay, E divided by E1 is equal to this figure. Similarly, we calculate P divided by P1. What is P? P means price level in India, 174.3. In US, the price level is 296.17 and P divided by P1 is 0.59. We know the formula of REE. We have discussed the formula of REE. Formula of REE is E divided by E1 whole into P divided by P1 to the power W. Okay, REE is E divided by E1. This particular figure we have calculated. Okay, P divided by P1, this particular figure we have calculated. To the power W, W is the weight of USA. What is the weight of USA? Just look at the weight. Weight of USA is 30.60%. That is 0.306. 0.306, and we calculate the figure, that is 0.109. In this case, we can calculate the REE in India, which is given by Reserve Bank of India. In this case, in India, we REE is computed. So let me summarize my discussion today. In today's class, we have discussed regarding different parity conditions, and we show the parity conditions by taking the relationship between exchange rate and interest rate, exchange rate and inflation rate. When we take the relationship between exchange rate and inflation rate, we have discussed regarding two important theory, law of one price and purchasing power parity theory. And next, we have discussed regarding exchange rate and interest rate. In that concept, we have discussed regarding interest rate parity theory. Next, we have discussed something regarding currency reserve. What type of reserve we keep and what are the components of that reserve. At last, we have discussed regarding the concept of NER and REE. NER means effective exchange rate, net effective exchange rate or nominal effective exchange rate, and a real effective exchange rate. We have solved some problem how REE is computed in India. Okay, so these are two important exercises. You can practice it at home. Activity 1, activity 2. The important questions is, what do you mean by law of one price? We have already discussed. And what is purchasing power parity theory? What is the difference between absolute purchasing power parity APPP and relative purchasing power parity theory or RPPP? Next, what are the limitations of purchasing power parity theory? What is covered interest rate arbitrage and uncovered interest rate arbitrage? We have discussed. And what is the linkage between exchange rate and balance of payment? And next important question is REE and NER. And these are some problems you can solve it at home, and this is the references I have followed for taking the class, and you can see those references and this suggested textbook for knowing more regarding the particular topic. Thank you all. Thank you for attending my class. Thank you all.